Well, when we're talking about economic nexus thresholds, the first thing I suggest is always contact Clarus Partners. But we'll get into some of the details on this today. First, I have to mention physical nexus. And when I say physical nexus, we're talking about salespeople, employees, inventory, rental of personal property. If you have physical nexus, that's always going to trump economic nexus, okay? As far as economic nexus is concerned, in 2018, everything changed. That was when the Wayfair decision required remote sellers, i.e. sellers without a physical presence in a state, to collect and remit sales tax on their out-of-state or remote sales. But there are de minimis exceptions relating to both sales and transactions. In other words, there are minimum thresholds that must be met on remote sales before a state can compel a seller to charge sales tax. There are two factors here, but we'll soon see some of the complexities involved. Number one is the dollar amount of annual sales revenues received from a particular state. Number two is the number of annual transactions in an individual state. So you might think we would start this session talking about revenues or transactions, but you're about to see just how cloudy this topic can be and how it helps to have a professional on your side to bring clarity. Both revenues and transactions are measured annually. But what's a year? Well, typically we think about a calendar year, right? 1/1 to 12/31. But not all states say that. Some states define a year to be trailing 12 months. Some states say trailing 4 quarters. If you have significant sales in a state in, say, both December of one year and January in the next, you could come up with a different result than if you looked at just calendar year, January through December. Next, we'll look at the dollar threshold of sales. Thresholds begin at $100,000, but this varies. Generally, with larger states, you will see higher thresholds. I'm in Texas. It's a large state. We have a $500,000 threshold. Our neighbors to the north, Oklahoma, is a smaller state, $100,000 threshold. Next, well, what is a sale? Again, it's not quite as clear as you might think. Sometimes states will say, well, we'll look at your total sales. Some states will say, we'll just look at your sales of TPP, or tangible personal property, as opposed to services, intangibles, or real property. Some states will define sales as specifically limited to taxable sales. In other words, you back out your wholesale sales. So a manufacturer who sells their goods to retailers, who will then resell the goods. These receipts by a manufacturer to the retailer are sales, and they are sales of otherwise taxable goods, but they are non-taxed sales due to the exempt nature of the transaction. Typically, a basic tenet of sales tax is that it should be borne only on the ultimate consumer rather than on any purchases prior to the final sale. Retail sales. These will be defined as sales to the ultimate consumer. That's how some states say, is they determine their sales threshold as being retail sales. I'll give you a quick example. I have a client that does not sell to individuals. It does not sell to businesses. It does not sell to charitable organizations. So what's left? They actually sell exclusively to governmental entities. So think about it. They don't sell to wholesalers. They never collect sales tax on their sales since they're only selling to the government. But all of their sales are at retail, as the government isn't reselling these. So they still have a filing requirement in many states. Lastly, let's look at transactions. First off, the term transactions is generally not well defined in statutes. Is a transaction a line item on an invoice? You may have one invoice with 50 line items. Is it an invoice irrespective of the number of line items? Is it a payment? Typically, invoices and payments may be the same, but well, what if you habitually send invoices requiring a deposit prior to the final payment? I'll also mention some other nuances. First, the current trend in states is to eliminate the transaction threshold. South Dakota was the first state to write an economic nexus law. Since they included transactions in their law, most states just mirrored this provision. But this has resulted in some situations where sellers may be selling low-cost goods and meet the transaction threshold, even though their dollar sales may be comparatively low. Lastly, while most states are or states, meaning they require collection and remittance of sales tax if the seller meets either the transaction threshold or the dollar threshold, there are some states that have and laws, meaning the seller must meet both the dollar sales and the transactions threshold. Now, think about this. In New York, they have a $500,000 sales rule and a 100 transaction rule. So you could sell 80 $10 million airplanes in a year into New York remotely. But you would not have a requirement to file sales tax returns because you were only selling 80 and they are an and state. You didn't reach the 100 transactions. By now, you can see the complexity with the economic nexus rules. Contact Clarus Partners to help you bring clarity to these issues.